Hi everyone, thanks for tuning into my channel today, All Things Accounting. What we're going to be talking about today are adjusting entries, what they are, and we'll run through some examples. So stay right there and we'll get through this together. So adjusting entries, because of the time principle of accounting and the matching principle, we want to be able to match any expenses that are belonging to appropriate accounting periods. So periods are broken up into usually monthly and annually. So what we want to do is when an expense is incurred, for example, we want to be able to recognize that in the appropriate period, or when something is used up, such as supplies, prepaid expenses, which are assets, then we want to be able to recognize how much was utilized as an expense and reduce our asset account. So we'll go through that on the whiteboard and run through some examples. So follow me. So adjusting entries, what the essence of adjusting entries are is that it brings asset and liability accounts into its proper balance. So we'll run through some examples here. But things to just keep into mind here is that when an adjusting entry is done, it is usually done at the end of the accounting period. All right. So let's look at some prepaid assets. First of all, we'll look at the definition of assets again. Remember, they have to be owned. They have to have current or future benefit in helping you generate income, which is the ultimate goal for running a business, is to have income. So examples of some prepaid assets would be prepaid insurance, prepaid rent, and prepaid supplies, just to name some. Now, let's say on example here, let's say on January 1st, 2021, ABC company paid a certain amount, in this case would be $2,400. $2,400 for 2 years of insurance. So on January 1st, what we would have to account for is a journal entry debit prepaid insurance, and credit. In this case, if we're paying it on account, it would be accounts payable, or let's just say, for argument's sake, it's cash. So it'd be $2,400. Now, that's on January 1st. Now, on January 31st, 1 month's worth of coverage is used. So on January 31st, what we would have to do is debit what we had used. So this would be insurance expense. It becomes an expense now, and credit the asset account, which is prepaid insurance, because it is now used. Now the amount that we're going to be doing that for would be $100. How do we arrive to such an amount? We know that it would be 2,400 multiplied by 1 month for how many months of 2 years? That's 24 months. That's how we arrive to these dollar values here. And of course, underneath again, you'd have an explanation for both. Let's run through another example. So let's say for prepaid supplies, on January 1st, ABC company bought $3,600 of supplies for the office. On January 31st, when we count the inventory in this case is counted, we find out that $2,550, so $2,550 worth of supplies is still on hand. So, therefore the amount that has to have been used in this case is calculated as 3,600 minus the 2,550. So that yields 1,050. Therefore, on January 31st, what we would be debiting is supplies expense and crediting our supplies account to reflect truly what the amount is. So in this case, it's 1,050, 1,050. One last example that we'll go through unearned revenue. So unearned revenue, which we know is a liability because if we have not earned, meaning that we did not deliver the goods purchased or rendered the services sold, then we cannot truly recognize the revenue. It's a liability to us. So it's usually cash that's received in advance for goods to be rendered, services to be rendered. So in this case, let's say on January 26, ABC company received $1,500 for future consulting services. And this is $1,500 on per month. Okay, so they received that for that month. So on January 31st, 5 days of consulting services were rendered. So we earned the revenue in that case for 5 days. So what we would have to do is calculate this. So making the journal entry, we would debit the unearned revenue. We reduced our liability account because now we've earned it, and we credit the revenue or consulting revenue. So in this case, it would be $250. How did we arrive to that amount? Because it is $1,500 that we received multiplied by 5 days that we rendered services for a period of 1 month. All right. So because on January 31st, that's when our accounting books closes for the month. So we have to account from the 26th to the 31st, which is 5 days. So if we look at the T accounts, unearned revenue, originally on January 31st, on January 26th, we had $1,500. And by January 31st, we rendered 5 days worth. Therefore, the net impact on this is $1,250. That's how much liability that we still have left. And therefore, under the consulting revenue T account, so if we look at the consulting revenue, then that's a credit of $250 on January 31st. Okay. So I hope these examples that I've ran through with you help you understand a bit more about adjusting entries and its purposes. If you enjoyed this tutorial, please subscribe to this channel and remember to hit that like button and hit that bell notification icon so that you're always up to date on the new videos that I'll be posting. So until then, take care.